Welcome to this explainer. Right now, we're unpacking a massive geopolitical trade bombshell that literally just erupted between the US and Canada, and more importantly, what it means for your portfolio. Look, whether you're a seasoned investor or you're just trying to protect your savings, you really need to understand the mechanics of what's happening here. The headlines are flying fast, and the market implications, they're very real. The breaking news, and the reason this is so urgent, is that the United States has just announced an unprecedented 50% tariff on a massive sweep of Canadian imports. And this staggering levy is slated to take effect really soon on August 19th. We are talking about a major, immediate disruption to one of the largest trading relationships on the entire planet. Now, what's really fascinating to me here is the legal mechanism behind the move, because this isn't your standard trade action. No, it marks the first recorded time a U.S. president has maxed out Section 338 of a trade law passed nearly a century ago, the Tariff Act of 1930. Basically, this law allows for a maximum 50% tariff when a foreign country is deemed to be discriminating against U.S. trade. Pulling a lever from 1930 brilliantly illustrates just how aggressive and, frankly, historic this trade posture has become. So, Section 1, 3 triggers: cars, booze, and cheese. Let's dive right in. The U.S. officially claims that Canada is utilizing what they call discriminatory trade practices to actively disadvantage American businesses. And they've zeroed in their grievances on 3 distinct sectors. We've got alcoholic beverages, automotives, and cheese. And just to be super precise here, we're not talking about all dairy, but specifically products like cheddar and a few select cheeses. Let's break these down, starting with the booze. The absolute most glaring grievance cited by the White House is a staggering 81% drop in U.S. alcohol exports to Canada between 2024 and 2025. I mean, for an industry that relies so heavily on cross-border sales, that's not just a dip, that is a devastating cliff to fall off. But the crucial point is why that drop happened in the first place. It occurred because Canadian provincial retail monopolies, think places like the LCBO in Ontario, effectively banned the purchase and distribution of U.S. alcohol from their shelves. See, in Canada, alcohol distribution is heavily controlled by these provincial crown corporations, and they halted U.S. purchases as a direct, coordinated retaliation to prior trade disputes. Moving on to the second trigger, let's see how this builds. In the automotive sector, the U.S. points to a highly specific 22% decline in imports of U.S. motor vehicles into Canada. And you guessed it, this decline wasn't an accident either. It was driven by a 25% surtax implemented by Canada back in April 2025. This tax hit specific passenger vehicles and trucks originating in the U.S. that didn't qualify for preferential duty-free treatment under the USMCA, or as they call it up north, CUSMA. Basically, even compliant vehicles get charged on the value of parts that don't originate in North America. Finally, we have the cheese dispute. The U.S. is arguing they are at a massive disadvantage in the Canadian cheese market. Why? Well, under current tariff rate quota rules, which strictly limit how much can be imported at lower tax rates, U.S. retailers just can't get allocations to sell directly to Canadian consumers. But here's the kicker. European Union retailers do have that direct access privilege thanks to their separate CETA trade agreement. So the U.S. naturally sees this discrepancy as a totally unfair trade barrier. All right, moving to Section 2, economic impact. Who actually gets hit by all of this? No, a 50% tariff sounds completely apocalyptic, right? But let's actually look at the data. The U.S. Trade Representative estimates these new tariffs target about $20 billion worth of Canadian goods. Now, when you zoom out and put that into perspective, that represents roughly 5% of Canada's total exports to the U.S. So 95% of the trade actually remains completely unaffected by this specific action. What's truly fascinating is the surgical precision of this target list. The items getting hit are wildly specific. We're talking plywood, wood products, and spirits, all the way down to quirky things like hockey helmets and wigs. Meanwhile, the U.S. carefully exempted vital macroeconomic categories that they desperately need to keep their own economy running, things like energy, potash, critical minerals, and civil aircraft. Oh, and they also exempted items that are already facing existing Section 232 tariffs, like timber, steel, and autos. Section 3, Canada's defense and counter-arguments. It's absolutely crucial we look at both sides to see where this standoff might lead. On the automotive front, Canada counters the U.S. grievance by pointing out a really crucial timeline detail. They argue that their 25% surtax was merely a reciprocal response. In their eyes, it was specifically designed to mirror the identical 25% Section 232 tariffs that the U.S. had already placed on Canadian auto parts. So to Canada, they're just matching exactly what the U.S. did first. And regarding the Great Cheese Dispute, well, Canada notes that despite the U.S. complaining loudly about restrictive quotas, the numbers actually show something else entirely. The U.S. is already the single largest exporter of cheese to the country, currently dominating over a third, more than 33% of Canada's total cheese import market. As for the alcohol ban, honestly, this might be the trickiest one to resolve. Canada's leadership emphasizes that this move wasn't just a top-down federal mandate. It was implemented by provincial premiers. But more importantly, it has overwhelming domestic public support. Recent polling shows a massive 73% of Canadians actually support keeping U.S. liquor off their shelves, viewing it as a completely justified retaliation. Section 4. The Section 301 add-on, which introduces a whole new global tariff layer. As if things weren't tense enough, the U.S. is stacking an additional 10% tariff under Section 301. They're citing a lack of Canadian border enforcement against international goods manufactured with forced labor. The U.S. Trade Representative claims Canada essentially acts as a dumping ground for re-exports, pointing out that Canada intercepted only 2 shipments in 6 years, compared to thousands stopped in the U.S. And remember, this 10% is slapped right on top of the impending 50% rate for those targeted goods. Which brings us to Section 5, Investor Takeaways, what this actually means for you. Okay, here is your actionable checklist. First up, you need to closely monitor those heavily exposed sectors. Over 50% of Canadian distillery sales rely on the U.S. market. That is immense, immediate downside risk. Forestry, particularly plywood and lumber, is also heavily exposed right now. Broadly speaking, brace yourselves for market volatility. Remember, the U.S. refused to renew the USMCA back in July, meaning the CUSMA trade deal is now under continuous, tense annual reviews. And critically, keep your eyes peeled for any concessions or negotiation breakthroughs leading right up to that August 19th deadline. So, all of this data really leads us to the ultimate question we have to consider as we watch the calendar tick closer to August 19th. Do these extreme measures represent a brand new, permanent normal for global trade, where historic 1930s laws become everyday weapons? Or is this simply the ultimate high-stakes negotiating bluff designed to extract some last-minute concessions? Keep watching the data, stay objective, and keep your portfolio agile. Thanks for joining me for this explainer, and I'll catch you in the next one.